So let's continue our discussion of risk analysis. There's a type of analysis that's referred to as sensitivity analysis. This analysis changes one input at a time to see its impact on net present value. It helps identify the variables with the most influence on project viability. In our project, unit sales and cost per unit show very steep sensitivity lines, highlighting them as the biggest risk factors. So managers must closely monitor those variables. Those are the variables that they need to spend the most time and money on in researching their importance and to try to get as accurate a prediction as they possibly can. Now, this can be done with any variable. Net present value can be adjusted to look at changes in net present value when any variable changes, like units sold. The traditional NPV profile shows net PV as when weighted average cost of capital changes. So you would want to explore those variables that have the greatest influence on net present value. As we'll see in a second, salvage value typically has very little influence on net present value itself. So we have a table here that shows what happens if column one here is the units. What happens if the units change by anywhere from 0% to negative 30% and to positive 30? We see that in general, this is unit cost, I'm sorry. So as unit cost changes, the greater the cost, the lower net present value will be because cash flows will be different. In addition, unit sales. If sales decrease, we know that obviously revenues decrease. And we can see that there's a 30% up gives us 134,000 net present value. And as you can see in this graph, there's really not that much difference between negative 30 and 30%. There's a 60% range there where we have really less than $8,000 difference in net present value. So the point here is if we can graph these numbers, we can now look at what the net present value profile looks like. Here is the units sold. Obviously, as we sell more units, the value goes up, and we can look at the slope of this line. It is fairly steep. That means it's pretty important. Likewise with cost per unit. If costs go up, we know revenues go down, we should have a negative slope. And again, we have negative, and again, it's pretty steep. But with salvage, we see there's very little change. So if I were a manager and I had three things to look at, I wouldn't pay any attention at all to what my salvage number was. I'd pick something that would seem reasonable, and then I would go with it, and I wouldn't deal with it anymore. I would spend all of my time trying to estimate what's the cost per unit going to be and how many units are we going to be able to sell. That's where we're going to spend our money in our research. The basic weaknesses here then are sensitivity analysis doesn't look at diversification. It doesn't talk about the chance that variables will change. So it misses some of the characteristics of the variables themselves. Why is it? It's quite useful actually because it gives us an idea of standalone risk. It helps identify these dangerous variables. And it can give us some break-even kinds of information on the impact of variables. So we can make some decisions on the costs and the purchase of assets. So again, we also have another type of risk analysis called scenario analysis. This particular piece looks at several possible situations. So usually we'll identify them as worst case, most likely, best case. This gives us a range of possible outcomes that we could look at. So if we look graphically at this, right, the best case scenario for unit sales is 1,200. The stock price or the unit price is 240. So that's going to give us the highest net present value. The worst possible case, we'll only sell 800 things and we'll only be able to sell them for $160. That gives us this negative net present value. Now we have to determine probabilities. What's the chance that these economic events are going to happen? That could be one of the stickier points with using scenario analysis. But in this example, we have an expected net present. The average is 72,000. Standard deviation is 103,000. Coefficient of variation 1.43. So we can get statistics in order to determine the statistical value or the riskiness of these projects. So what is simulation analysis? This is a computerized version of scenario analysis that uses continuous probability distributions. The computer is going to select a value for each variable based on some given probability distributions. It'll then pick a random variable for unit sales and sales price, for instance. Substitute these values in the spreadsheet and calculate net present value. It's going to repeat this process many times. So it's going to take this scenario planning one step forward, or one step ahead, I guess, or deeper into a little bit more. Uh, since we're choosing many things, we're looking at all possible changes in our decision making. So what will happen is the normal distribution for this example, we said the mean is $1,000 for sales, has a standard deviation of 200. Normal distribution for unit price is 200. Standard deviation is 30. So now we're going to plug these statistics into the variable that we use, and it will select then a variable based on those things. So it will select a number within the relationship, the mean's 1,000, 200 standard deviation. It's going to choose a random variable, plug it in, and then it will calculate those values. So it came up with a mean of 199, 999 units, gives us a net present value. Standard deviation gives us a picture of 325,000 is the maximum net present value, and the minimum is negative 142 with a median of 64,000. How do we get that? These statistics came from doing this 2,000 times, which basically creates for us a frequency distribution. So now we have this frequency distribution that shows all the outcomes and the probabilities of those outcomes. So in this case, we end up with a mean net present value of 88,808. And the probability of a negative net present value in our calculations, again, if we use our statistical analysis, there's only a 13% chance that we would have a negative net present value, which seems like it's pretty low to me. So what are the advantages? Reflects the probability distributions for each input, shows the range of net present values, gives us, again, an intuitive graph of the risk itself. The disadvantages, coming up with the correct probability distribution for each variable is difficult. And if inputs are bad, the output's going to be bad. So the overall disadvantages of simulation itself, sensitivity, scenario, and simulation analysis don't provide a decision rule. None of these things really give us a decision rule. They do not indicate whether a project's expected return is sufficient to compensate for its risk. Again, these three analyses all ignore diversification. They measure only standalone risk, which may not be the most relevant risk. So, how might we use this? If a project, we may have a set of rules, if you will. If a project has a CV between zero point 0.2 and zero point 0.4, then we would assess that that's maybe a high or low risk, and then we would attribute some form of adjustment to the weighted average cost of capital. So CVs for scenarios, this is 1.43 from the simulations 1.65. So both of these are greater than the 0.4. So this project is going to be seen as being high risk. So the coefficient of variation measures a project's standalone risk. High standalone risk usually indicates high corporate and high market risks. What we need to do is adjust then our weighted average cost of capital for this analysis. Maybe we do a 3%. If the project's required return was 10%, because it's high risk, we add 3%. That gives us a 13% required return. Again, that's 30% above our base. That means our net present value should be around $41,584. The project remains acceptable after accounting for the differential on this higher risk. Should subjective risk factors be considered? Absolutely. Not all risks are captured numerically. We have legal risk, reputation damage, regulatory uncertainty. All of these are subjective in nature. For example, a firm launching a controversial project might face brand backlash, a risk that doesn't appear in financial models. I think in general, if you think about our most recent history, Cracker Barrel, from all that I can gather, had a serious blunder when they tried to rebrand their product, and the product being the restaurant itself. And that had severe backlash from investors. That cost the company, if I'm not mistaken, around $145 million in value. Now they've reversed that. They said, nope, we hear you. We're going back to the old thing. We've gained back some of that market value, but not all of it. What is a real option? Real options exist when managers can influence the size and risk of project by taking different actions during the project's life. That is, after we get started, opportunities for increasing and or decreasing projects may come to light, right? So real options give firms flexibility to adapt. What could these things be, right? We could talk about investment timing options. When you actually increase asset size, right? We can choose when to do that. So that is an option that management has. We could talk about growth options. We could either be expanding the product line, maybe going into new products or new geographic markets. Abandonment options. When should we get out, right? We need to be able to have this flexibility once projects get started. Again, remember, all of this is based on prediction. What if something happens in the world, let's just say COVID, and all of a sudden the project that we started last year is really now in trouble? Do we continue, hope that it fits, or do we decide to make changes? That's what real options are all about. One of the things I did want to mention, though, is one of the changes in the tax code. If you remember, there's now something called a bonus depreciation. It's only good till 2026, but it is in place now. So what is the bonus depreciation? Well, this is 2025. So this year, investors can take 40% of the depreciation the first year, in addition to the maker's deduction for whatever the remainder is. So that's a little bit hard to describe here, but let's look at an example. So we have an asset, it's a 3-year class asset. We put it in service in 2023. In 2023, I was allowed to take an 80% bonus. 80% of the basis is $80,000. That leaves $20,000. The first year's maker's percentage is 33.33%. 33.33% of 20,000 is 6,666. So the first year's depreciation for this project is going to be $86,666. And of course, these remainder balances here are all based on this remainder basis, not the 100,000, on the remainder basis. So again, tax code changes sometimes to our advantage. This is a great advantage to business, to be able to write off these assets, reduce the tax burden, and then be able to hire more people, buy more assets, expand and grow operations. So to value a firm or stock, we have to estimate future cash flows and then discount them using a rate that reflects risk. Capital budgeting helps us understand a project's value. Cash flow estimation and risk analysis refine those valuations, ensuring we make informed decisions. So there are many companies we can look at for examples, right? Apple uses net present value. Microsoft applies scenario analysis for its cloud investment decisions. So capital budgeting is not just finance theory. It's a vital tool for strategic leadership. Thanks for listening to these videos. Hopefully I'll see you soon. Bye-bye.